Good morning, good afternoon. Whether the market is riding low or high, make sure to stay informed with the mortgage guy. I hope you're ready. I'm ready. It's time for your market update. All right, we're just going to jump right into it. Past couple of weeks, we have been taking things a little bit slower because I'm walking you through a lot of terminology and what things are. So now we're going to be more of a flyby. So we're going to pick things up and kind of move it along. So I'm going to go ahead and share my screen. I haven't even looked into this stuff today, so you're going to do it just the way I would on a regular day. So I'm going to go here into the fear and greed index. Keep in mind, I'm going to open up my Excel sheet. I'm just going to kind of chart these down, and I'm going to basically come up with my results on what I feel the market is in its current state. So we're going to go here right now, very strong. I mean, we went from extreme fear all the way down here, okay, all the way up to extreme fear right about there, and then about fear, and now we're all the way in this neutral, almost greed. Wow. So the fact that we're in a neutral, how high we came, that's definitely a positive. So definitely got a positive there. I like the fact that we're neutral. We came all the way from here to up there. This is a really good sign for us. Market momentum. So you see this nice momentum going up. I mean, this nice market momentum going up, but you do see it is in fear mode. We're just above this line. Okay. So ideally, again, you want to, like, this was extreme, like we were in extreme fear. Okay. But now that we're just coming over this line, we have moved into fear, partly because we're kind of coming down right here. I don't like that downside. A lot of my more future side of things, so not like tomorrow or next week, but in like the next 3 to 6 month outlook, I do foresee this actually coming back down. There's a lot of reasons behind that, but for the most part, again, we see this kind of going up, and hopefully it continues to go up. That would be great. I'd love to see this move out of fear into greed. That would be very nice. But I'm gonna give that an equal sign because I don't really have a positive or negative outlook on this. We do see it has increased, so we're gaining some momentum, which is good. So we do hear stock price strength. So we do see that also is increasing. So we're in extreme greed. So you can kind of take that one way or another. When you see extreme greed, so we see this increase, we're in now the positive, which is a good sign, but you see this run up. And the one thing is you can't let the market fool you. Like, do not let this market fool you, okay? What the market likes to do, okay, because think of a market as its own human being. The market likes to make you think like everything is nice and dandy, and then it just will eat you alive and just plummet. And so, based on, again, a lot of things we're seeing, this extreme greed actually fears me. The fact that we are this greedy right now, and that things are, improving so drastically, so quick, that actually is an indication of something bad. Because that could mean, hey, we're getting everything prepped and ready for a dump. And when that happens, then people lose money and the government gains money. Okay. So we don't actually want that, but this is a good thing for the extreme greed because that is the current state. So if I'm basing this on the current state, that's the way I have to do it. So I have to give it a plus. But again, to me, that's actually a bad sign. Stock price breadth. So again, extreme fear because we have been tanking. Okay, so we see stock price strength going up and stock price breadth going down. So just to recap on what breadth is, okay, because we know obviously what the price is. So market is made up of thousands of stocks. On any given day, investors are actively buying and selling them. This measures the looks at the amount, volume, and shares on the New York Stock Exchange that are rising compared to the number of shares that are falling. Okay, so there's more shares falling at this time. Okay, this shows that we have some strength in the price, but as far as stocks themselves, there's more that are falling. So again, this kind of, when you see this go down and this go up, this is actually a bad combo sign. So I'm definitely going to give this a negative here. So these kind of offset themselves. But again, I would use this more as an indicator in stock price breadth. Put and call options. So again, options are contracts that give investors the right to buy or sell stocks, indexes, or other financial securities. Agreed upon price to date. Puts are the option to sell, while calls are the option to buy. Okay, so right now we're seeing a little bit of a buy sign. Again, we do see extreme greed. So we are seeing some buy, but this isn't much. This is like a little tiny bump up. Okay, so there's definitely a lot of selling still happening. Is this going? So we see here again, the fall means a lot of people are selling and pulling out of the market, or not people, investors. So we take that down here. Again, we do see quite a nice dip in sell. So again, puts are the option to sell, calls are the option to buy. There's not actually as many calls right now from what it looks like. But again, where we're at, it's still at a decent level, compared to down here. Okay. So again, that's kind of a neutral, but again, I have to give it a positive because I do see extreme greed. Market volatility, there is neutral, but look at this. You see down, up, down, spike up. There was a spike down right here, but it popped up. So I consider this up, down, up, down. This is just a big up. This is just like an oopsie, a little market correction, maybe some market manipulation that you could call it, and then pump down, up, down, up, down. Like this is a big down. Okay. So being that that's a big down, we could see market volatility kind of pan out, which for how long we've been in such volatility, again, it could actually start to come to, you could start to see these actually meet these two lines. That's probably where it could be headed. But at the same time, with some of this information, it gives me some not so great outlooks over the next 3 to 6 months. So again, this is neutral, so I'm going to leave it as equal. But it is nice that the market volatility has moved from, extreme fear, and now we're over here in the neutral side. Again, this is not a good sign, but usually when you have a big run down, you see some sort of run back up. So are we going to test these lows from October of 2021? I don't know. But right now we're in neutral. So I'll take neutral for right now. We do see kind of this pattern forming. This does lead me more to an indication that we're not on this trajectory going up. We're probably going to more do a curve, but again, it just depends. Safe haven demand. Again, bonds outperforming stocks. Stocks outperforming bonds are going up. So you did see here, we had some bonds outperforming stocks, and then we saw a nice little dump up there. So over in the UK and inflation rates around the world, we saw them come back with really bad numbers this past week. And so with those numbers coming in bad, inflation just hurting the markets, hurting the world markets, we do see that the US bond market also followed suit. And so US bonds were starting to be sold off as well. And so that's, probably in part of this run up. Again, why it's kind of like right here, you see August 17th as of yesterday. I would still anticipate this to take a turn down just because of the state being overall in neutral. And you see this extreme greed up here, even with the stocks, falling. Okay, so we see, again, with the stock price breadth, there's more stocks that are falling than gaining. So we do see here that when we're looking at the safe haven demand, odds are we could see bonds retake a curve down to outperform stocks again. Keep in mind, investors could go into stocks because stocks could be outperforming bonds. Bonds could be outperforming stocks. But if there's also another situation where maybe they're both doing good or both doing bad. So if they're both doing kind of the same thing, you kind of will see this neutral side. But if they both do bad, investors could just pull out. This indicates investors are pulling out, which is why a lot of people don't look at this. But from a stock standpoint, they're pulling out. You go down here and you see stocks are outperforming bonds, but investors are pulling out of stocks. So what's happening with the bonds? Are investors just pulling out of the bonds at that point? So that just kind of gives more indication that's probably a bad thing. Again, here it's saying extreme greed. I look at the bonds versus the stocks. I want the bonds to do better. So I'm actually putting this as a negative in relation of the mortgage world, junk bond demand. So you see here, again, extreme fear. So we're going to go ahead and put that as negative. Cool. So we just go up here, Market Watch, U.S. Bureau of Labor Statistics. Let's just see what's going on here. CPI, I'm not going to get too deep into these, but we do see CPI was unchanged in July. So we're going to give it equal. Unemployment rate, 3.5. So that's probably an equal because that really hasn't changed much. Payroll employment increased 528,000. Average hourly earnings increased by 15%. I mean, sorry, 15 cents, which that's probably a negative. The fact that with inflation and obviously having to increase income is not always a good thing. So we're going to put some pluses and minuses there. Then we go here. So producer price index, negative 0.5%. Employment cost index, 1.3%. Negative. Plus productivity. We do see that has dropped. So that's not good. We did see some more indications that just by, I mean, heck, you could just read the news. Employees are starting to work less and produce less in their 40 hours a week. There could be multiple causes to this, but for the most part, they're not as incentivized or whatever it may be. So they're starting, and also burnout. Burnout was the big thing. I'm sorry. And so with the burnout from COVID and having to work so much, people are now just drained and they essentially need a break. So who knows? Maybe companies will start to step up and say, hey, we need to offer, an extra, like everyone has to take a week vacation at different times, but everyone has to take a week vacation at some point, or who knows what. There's got to be something in there for a break for people who are in the labor force. So let's go down here, U.S. import. So the price, we had a negative 1.4% and export price, negative 3.3, negative and negative. Cool. So a lot of negatives. From April to July, the number of employed youth rises 2.1 million to 21 million. That's a big number, especially when you're talking about youth. So that means households need, once you're of age to work, you're starting to need to have, people go to work because of inflation or whatever it may be to help provide for the family. So I'm putting that as a negative based on that news. We already went over U.S. import, producer price index, and CPI. Okay, so that's all we're going to go over there. MBS, just going to take a look at MBS, see what we got going on here. Got to go. I hate when it does this. Look at movement.com. Let's see if it keeps the same. There we go. Cool. So right now we see the bonds at 2.8. It's not very good. We do see this kind of level pattern out here. Let's take it deeper because right now this was just last quarter. Let's go 1 year. Actually, let's go 2 years. I don't need to go back further. Okay, so this is a little too sporadic for me. So maybe 6 months, a little bit better. So you come down, bam. So this is pretty neutral. Again, like I said, from May all the way to now, we saw up, down, up, down, up. Wait, I'm sorry. So rates go up, yeah. So rates go up, rates go down, rates go up, rates go down, rates go up, down, neutral. There's a little drop here. What's going to happen at this point, but again, relatively neutral. So we're going to give that a equal sign for rates. Again, I don't like seeing the bonds, but again, we already kind of evaluated bonds in the first section of this, so we're not even going to worry about that. So let's go at 844. Jobless claims, let's see here, was reported at 250 claims for last week. So a decrease of about 2,000 from the previous report. So that's good. We do see some positive symbols there from the expected, which was supposed to be more. We go here to 932, nothing. Existing home sales, which trades closings in existing homes, decreased 5.9%. So we see a decrease in actual home sales. Anything else? Supply was unchanged from a year ago. Median existing home price did rise 10.8%. That's going to continue to happen. I'm telling you this, home values are going to continue to rise. Everyone is on the same page with that. Had 125 consecutive months a year-over-year increases, longest running streak on record. So again, do see a plus as far as home values go. So that's good for real estate agents. Even with the decrease, those end up balancing each other out of 5.9% in home sales. At 11, daily update as posted, blah, blah, blah. Okay. So here's that. Really no more to go over. We're still at the 4.5% coupon. And hopefully we can take that down to the 4, the 3.5, because we'd see rates really improve at that point. Cool. So if we go on over here, we don't need any of these updates. And certainly there's like a morning update. We're going to go ahead to buy the numbers. Again, I just like to point this out when it is on here. So this was 8:15. If they still have the zombie companies on here, just remember 1 out of every 6 companies on the stock exchange is a zombie company. So we started off really big. Inflation Reduction Act 2022, started by Bernie Sanders. June 2021, pushed for 10-year social spending package, projected to include $6 trillion of outlays over a decade-long period. Proposal followed the American Rescue Plan Act, a very large spending bill, reduced in size, getting even smaller. How about now? Recognized by the BBB. So there's definitely some information in here. I'm not really seeing a whole lot other than a lot of spending. So raise money, just see these big numbers. 369 billion injected. I mean, where are they getting all this money? Clearly, they got to get from somewhere. Middle class, why not? So that to me is a negative. There's definitely a lot of negative. And so it's how can we spin the positive? How can we spin this to make it seem better? But certainly there's just, when I see a lot of numbers coming in here, a $6 trillion package, 1.9 trillion, 1.75 trillion. I mean, there's a lot. There is just a lot in there. Any insights that I can go over? August 18th. No, this is a live interview. Not going to worry about that. Let's go ahead and go into house price index map. Yes, this is a good one. Let that load. Okay, so we go over here. So we do see, so below national average, green is above the national average. We do see here. So right now, Maryland below the national average. That's not very good. There's a lot of gray here. We do see some changes though. So we have some gray. Maryland dropped below, Connecticut dropped below. We also do see, let's see over here. No, these have relatively stayed in the green. California, I believe, dropped. Some of these have been there. I think there's probably some more brown here. Again, we still have some green up in here. So just depending on where you're at, you can kind of see, are you below or above the national average, or are you kind of in the neutral? Okay, and then we'll go here. Nope, none of these. Cool. All right, let's go on to our next one. Let's go on to housing statistics. NAR, existing home sales, 25th of each month. We're still at 5.9, same as last month, or the last one that I released. So 5.9 decrease in home sales as far as that goes. Average mean price. We're not going to open that up. That's fine. So let's go back. Minus 5.9. Pending home sales. Let's see where we're at there. Minus 8.6. Those some more negatives. Negative. I'm going to go down. House affordability index. Index data. Just going to monthly. Wants to pop up. Boom. Load. There we go. So here, did we go? We still got June. Okay, so we're still in June here. Again, there's not going to be a whole lot of changes from when I went over before. You do see here, again, there are some increases. Actually, I think this did update for May. My apologies. So we do see now that the June to June is in there. So with June, again, we do see another increase in the home value. Obviously, the mortgage rate had an increase as well. These will get affected by that. Median family income did increase to 91 from 90. So a nice more than $1,000 jump. Qualifying income, which is crazy, is more than the median family income. So that has now officially surpassed on a national level from the median family income. So that means we are using income from other sources. So there's way more cosigners that are not just, part of the median family income. So qualifying income has increased. There are some other factors that could adjust to that. affordability indexes, we have officially dropped below 100. So that also is not a great sign. That means more FHA mortgages or more mortgages with higher debt to income ratios as well. Again, you see the prices. Midwest did pop up. I mean, that's a pretty decent bump up in the Midwest. South had a little bump up, West not much, and Northeast a little bit. Same rate. Obviously, the payments in these will stay the same. And again, just remember payment as a percentage of income. That's considering this, just the monthly principal and interest. That's not considering taxes, insurance, homeowners insurance, and then the other debts that you have for your back end ratio versus your front end, which is just housing and including HOA dues as well. These like 35% tells me that's probably more like 50+% in most cases. So what's Fannie Mae and Freddie Mac going to do? Well, they already are continuing to roll out new stuff. Expect them to roll out more stuff to be able to get more people to qualify. And then you see over here qualifying again 141 over 98. I mean, come on, that is insane for the West. So they are really, finding ways to generate more income on an application. 102 to 104, that's pretty tight. Again, still very similar to here in the West, but it's still not overtaking. Obviously here in the South, it's equivalent. So that does indicate again about the same, but the Midwest still holding strong with higher median family income, but also only one person. So that means, tax rates are lower, whatever it may be. So there we go. So there's that information. So we're going to go back. So we're going to give here, obviously we already evaluated home values, but I'm going to give that a negative actually, because the fact that there's more cosigners, houses are less affordable at this point, and home values are increasing is actually not a good thing for home buyers. So what's going to happen to home prices? Again, if we're going to see them continue to increase, which I think we will, what's that going to do? So affordability distribution curve, I believe. Let's go do. Okay, we see most affordable Iowa, Ohio is wow. Yeah, so Illinois, Kansas, West Virginia, Ohio, Iowa. They go down here, Idaho, Utah, California, Oregon, Washington. You see here 0.89, so that's pretty high for Maryland. Ohio, again, 1. Indiana, 0.91. So a lot of these remain pretty unchanged from the last one. That's what we will continue to see. Just looking here, California, like 0.46, Washington, 0.48. Like some of these states on the West Coast, just really expensive to live in. And down here, I mean, Florida, the fact they're at 0.49. Yeah, so some of these are just really, really getting expensive. The fact that Idaho is 0.43 is just wow. Hawaii 0.52, Alaska 0.77. I just like to look there, just kind of interesting. All right, then we go to I guess we can go here, metropolitan median home prices, or no, I don't want to go to metropolitan. We don't need to worry about that, unless you're specifically in that area. And then housing shortage tracker, our last one. So we go here to housing shortage tracker, and let's go on down here. So again, high housing shortage, dark red, over here in California, Lafayette, Indiana. Wow, that now popped up. Again, Champaign, Alabama, Florida, of course. You're seeing, New York, New Jersey, Jersey City, some areas over there, PA, Pittsburgh, huge housing shortage. Need for more permits. I mean, just permits are still just all over. Obviously, you can still see a good part of Maryland, and some other areas like right there, Columbus. Some of these areas also have a lot of development. There's a lot of people moving to Columbus, Ohio, so there's a lot of development there. I know that. Obviously, Alabama, you're probably going to find more people, flocking from, some more expensive states out to the Midwest, the South, the East, whatever it may be. So you're going to need more permits for more building, so you can bring more people there. No job creation, gray. So all this, no job creation. Why would people move there? Job loss, obviously Kansas, Shreveport, some of these places all kind of stayed there. And certainly sufficient supply. But we did see a lot more job loss in this one. So that's kind of interesting. I would imagine with inflation and kind of this recession that we're in, because we are in a recession, we're going to continue to see that. And so that's pretty much it. So I would say this is, again, that's kind of, it just depends on your area. Let's see here. So 1, 2, 3, 4, 5, 6, 7 pluses only. Come on, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15 negatives, and 1, 2, 3, 4, 5 equals. So I would say, with 15 negatives, 7 positives, we're seeing here, you can just see what I'm doing. 5 equals, if you wanted me to have that there. No, it's not letting me put it there. Oh, maybe it is. And then positive. I would say obviously the negatives are outweighing the positives with the future outlook, seeing all these negatives as well, especially with some indications more on the charts that we saw in the fear and greed index and everything that goes into the fear and greed index. There's a lot of upcoming future issues that I do see. I would say we're probably in a position where you want to start hunkering down, get ready, because we're going to be in for quite a negative period for the next 3 to 6 months, especially for home buyers. For listings, maybe consider dropping your price a little bit. Again, some lenders are cool like me with that will are cool with being able to yeah, we're cool. Being able to put on lender credits onto deals or house listings so that you can go ahead and get that home sold, especially with the decline in home sales as well, and pending home sales also. So having homes sit longer, more incentive, so making it a temporary buyer's market before these rates do go down, because just know once these rates go down, they just go down. They don't like stop, but we're not at that point. And that's going to be a point where the government, at this point, it's going to be the government saying we need to stimulate the economy, so we have to drop rates. They're not there yet. Okay, so keep that in mind. We need the government to come in and say we need to stimulate the economy. What do we use? Real estate. So what are we going to do? Lower the rates is what it is. And so that's when you'll have your refis and more purchases, and you have this whole slew of buyers that don't qualify because of higher rates. They will now qualify. So take this information as you will. Obviously, I want you to be able to sell more homes. I want you to be able to use this information to get more home buyers, to be more educated. So make sure that you take this information, educate your consumers. We have a lot of negative. There's too much negative based on the standard information. You should be going to get this data, just like I walk you through it, and being able to walk your clients through it and say, hey, here's what's happening. Here's the data. I'm giving it to you. Here's my interpretation. What's your interpretation? I would expect it to be probably the same thing as mine. Wouldn't you agree? Yep. Okay. Get them on a tie down and go ahead and continue to help them actually educate them on how to buy a home in this market and what's going to happen in the future market, which based on this information, 3 to 6 months, not great, but over the next 6 to 12 months, this home you just bought, you're going to refi. Home values are going to go up. You're going to have more equity. You may not even need to buy out mortgage insurance because you might have so much equity based on the increases that we are still seeing. So again, a lot of education that you can pour out into your consumers. Make sure you use it to your benefit. I hope you enjoyed this, and I hope you have a wonderful day. And just remember, the mortgage guy, if you're looking to buy, if you have any home buyers looking to buy a home, need anyone who needs to refinance, or simply you just need a question to be asked, again, you don't have to use me. But again, hope you have a wonderful day and enjoy.